I'm Nico. I'm 28, coming from Germany, from Munich, working for 10x Founders. We're a pan-European fund, 160 million total, investing typically in pre-seed and seed rounds very early on. Have reserved 100 million of our fund to follow on. So we try to get in very early, help to build the company, and then double down until an eventual exit, stay for the very long term, and do that quite opportunistically, agnostically across all industries, all verticals. Very much software focus, I'd say. And I spend a lot of time on the CE market. We're talking to entrepreneurs very early on. We're one of the investors in Zoe. I think that's also what's bringing me to Warsaw quite frequently. And super bullish on European tech in general. And always, and I think that's quite special about what we do with 10x Founders. We take the very entrepreneurial perspective. All of our partners are former entrepreneurs. We try to run the company very entrepreneurially in terms of short decision-making processes, in terms of how we support founders. And we're very collaborative. So it's very rarely that we're leading around and not, say, like letting anybody else in. And it's a real pleasure to join Michael today on stage. We're co-investors. And that's a very common theme within 10x Founders, that we try to group the right people, the right brains around the table for the benefit of the company.
Thanks for that. We have two co-investments at the moment. Also, You Pacjenta is another. Nico, Ariel mentioned that a little bit, and I think that's quite obvious for us, not that much for others. How do you say, what has changed in 2022 versus the good old days, and when are the good days coming back?
Very good question. I would love to know. I have two perspectives on that, and I start with the second one first, with the latter aspect. Like, when is the good old times coming back? Like, I think when we, as investors and as entrepreneurs, we need to face a new reality, and thinking more of like the 2020, 2021 period of more like an exception. So I think the good old times that we knew for the last 2 years, I'm not too sure whether they will ever come back within the next decade. Like, we need to accept that, like, the funding environment we saw and the softer spendings particularly, that all of that was more an exception than a normal. And it's maybe also not the goal to strive for within the next years. But what I can definitely promise, like, particularly if you're building in software, if you're building in hardware, if you're building in digital tech, like, there's absolutely no way around digitization, around, and that's why I'm extremely bullish on, let's say, in general, on the outlook of what software companies can achieve within the next 2 years. If we look at traditional industries particularly, like, all of them need so much, in tech, they need so much software to increase their efficiency, to actually, like, achieve their own targets, to fuel their growth, that if you're building in tech, there's absolutely no need to worry within the next 10 years. But I think what has changed is that investors are looking very differently at business models. In Germany, there's like a lot of grocery delivery companies that got very highly funded over the last 2 to 3 years. Like, those business models have never proven to be profitable, even in a unit economic spaces. So what has changed to 2022 in terms of times is that you need to really build, and I think Ariel said it quite nicely, to build a sustainable, healthy business and not race on top of hype, on top of an idea, and then hope for the best.
There's one thing I always try to relate to. There is this formula of Benjamin Graham from, like, the Bible of investing, that basically you take the risk-free rate and you put 5% on top. And when the risk-free rate was 0, it was just 5% that was expected. Right now the risk-free rate is like 5, so it's much more, and that's why all the valuation and multiples have changed. And given the multiples, I think something that's very commonly not understood and considered almost not fair is, like, you know, you have some companies that get the valuation even on Series A like 5x the revenue, while the others get 50x or even more. Why does that happen? I mean, you know, I kind of know some companies in your portfolio, and I know you have the whole range. Yeah.
Yes, actually we do, and I think everything comes down, at least how we see it, our perspective is that everything comes down to investor expectations on that. Like, if you're paying a multiple right now in a software company in terms of, like, is it 5x, is it 50x, you're always kind of like trying to discount the future growth and the future potential of the company to the time right now. And there's definitely some spaces. I think AI is a super hot topic, generative AI in general, where investors are willing to pay more because they think that the eventual market that these companies are tackling and the overall solution has much more potential than starting out in a niche. And I think this is something that trickles down from an anticipated exit, maybe in 10 years down the line, to growth rounds, to the seed rounds, to Series A rounds, where investors basically just factor in like to what extent can I raise around at maybe 3x the valuation I'm paying right now in 18 to 24 months down the line. And if there's a lot of investors very bullish on generative AI and for a Series B round, then obviously you can also price your Series A round at way higher amounts. But that does not mean that it's a better or a worse company. It's just about how are investors looking at it and what kind of market prices are they willing to pay.
One point here, because there are some things you can probably change when you're fundraising, let's say 12 months from now. What do you think you would say might increase your multiple? Because obviously the traction will help you with the valuation. But what are the things you can actually focus on to deliver to change your multiple dramatically?
I think in the end, I would say also as public market investors and particular growth stage investors, you're very much looking not only at, let's say, like the top line growth, but the overall healthiness of the company. So have a good eye on your unit economics. And I think within that, I think being here and attending Ariel's lecture is already a very good start, because sales and how to run an efficient go-to-market machine is definitely one of the key aspects that I see. And in the end, if you do that quite efficiently, then there's definitely something that's going to boost your valuation. Even though, and I think that's maybe an unpopular opinion, and it's maybe easy to say as an investor and versus entrepreneurs, but like if you are in a situation that you need to focus on valuation, you may be aiming for the wrong goal. Like you want to build substantial businesses, and having an evaluation is just an intermediate milestone and maybe some type of proof point. But in the end, a good valuation at a Series A, Series B round is not helping you for a good exit. And I think that's something what not only entrepreneurs, but also we as investors strive for, to build healthy businesses with a healthy path into profitability eventually. And then hopefully everybody around the table will profit. And we won't do if we overraise or overvalue or overprice our companies at the earlier stages.
So with your, because you invest from pre-seed up to A round, with your seed or pre-seed companies that you're already working with, when they are raising, what typically do you advise them to do to make the process and the fundraising successful?
It's a very generic answer, but what I typically try to help the companies with is preparation. Like get your things done before you actually start fundraising. And I think Ariel ended his part on that also with his ending note, is that you need to like plan for fundraising, how much you want to raise, at which valuation, and do that 6 months before you actually start. Get your deck ready, get your financial model ready, challenge all your assumptions, plan out how the next 1-2 years of the company will eventually look like. And this is something where I spend most of the time with the portfolio companies with. It's actually like setting the scene for future growth. And once you have done that, then you can talk about optimizing on your funnel, on whom to approach in terms of investors, how to talk to them, how to design your pitch deck. Is it better to show this slide, that slide? How many slides do you need in total? But get the preparation right, get your thinking straight as a founding team, align with your current investors, and this is, I would say, already half of the task, and determining half of the success of your eventual round. And that's what you realize also as an investor if you're talking to a founding team and realize, okay, these guys have really spent time on preparation and they know what they're talking about. And it's a very easy bullshit filter for companies that just go out to raise because it's maybe a lifestyle decision.
I think this is something we see, and it's a very common yellow flag for us, that companies start the process and actually then they don't have the proper data room, the proper data sets to answer the fundamental questions. So what Ariel was, for example, showing on the funnel metrics, like if you're asked for that in the process and you cannot prepare that in like 2 weeks, that means you don't track it, which is like a major negative signal. And obviously if you have amazing traction and growing like crazy, sometimes you might not have it, but it will always help establish your positioning as a well-run company. Nico, on that point, what are the things that make you pass immediately when you see the company in a deck, in an email?
Very good question. I think it depends case by case. We are a very opportunistic investor, so we're looking at every, say, investment and deck we get on an individual basis, so that we don't apply, let's say, like top-level filtering as maybe other funds are doing. We invest in software and in hardware. We invest pan-European. So because of geo, because of industry, like very few investments would not pass our very first level of filtering. But there's some, I would say, some common mistakes, and I could talk 1.5 hours about that for sure, and give a whole masterclass and show examples of screenshots of decks I received. But what typically really turning me off is if you realize already from the deck what the ambition level of the founder is. And what I really realized is that the best founders we work with and the ones that raise the best follow-on rounds, that is thriving to exit, is the ones that already think extremely big from the beginning. And one of the indications I see, particularly in the German market, is if you receive a deck in German. I mean, like maybe for Polish founders it's a little different because once you approach international investors, you go to English anyway. But in Germany, it's very common to prepare your deck in German. Like, but how will you ever attract international investors if you're designing your deck in a local language? And apart from that, I think that's a very high level indication. But apart from that, like, how do people think about markets? How do they think about expansion? How do they think about like what type of people to hire? And if somebody tells me and puts a financial projection in the deck and says, well, in 10 years down the line, I maybe do 10 million of revenues, then I, as an investor, have to question whether people really understood what the venture way eventually means. And I think that's also what Ariel was referring to. We're looking for growth. We are okay if you're not profitable. We expect you to grow into a substantial size for the next 5 to 10 years. We are prepared to take a risk, but we need to dream big with the entrepreneurs. And if that's not the feeling that I get while skipping through the deck at the very first point, this is typically, I would say, my very first filter where many of the companies simply don't pass because we're not aligned on how to build a big company and whether the company is suitable for the venture path at all.
I think on the decks in Polish, I would totally sign off to that. And just to give you an example, I had a couple of companies I wanted to share with Ariel to meet, and the decks are in Polish. And it's like I might ask them or whatever, but I have the deck now. I need to forward it. Just not gonna work. For me, one point that I see very often is the way the market sizing is done. So very often I see that done poorly. And this is something like the data is out there in the internet, like whether you actually did some work or you're just shooting some random number from whatever Gartner research, which is like completely not relating to what you're really selling.
Yeah. Can I make one comment on that? I think for me, the market sizing slide is one of the decisive slides in the deck. And not because I need to believe that the market is big, but because it shows how entrepreneurs approach how they want to build their business. Because in the end, if you do that bottom up, if you define it very narrowly, if you know what your target persona is, Ariel also had a slide on that. I think this is all of the preparation and work that needs to go into the market sizing slide. I don't care whether McKinsey calls the market a 30, 40, 50, 100 billion market by 2032. I don't care, but I care about entrepreneurs being able to slice down a market, pick the most, let's say, attractive segment, and then execute on that niche. And then, yes, if it's embedded into like a larger market, obviously that makes it more attractive. But as an entrepreneur, show the investors with your market sizing slide that you know what you're talking about and that you know how to run your business. And do not copy something from Gartner or from McKinsey. I think this is not going to help you because investors will challenge it anyway.
Mm-hmm. In the investment process, there are some moments where you can actually leverage the dynamics. And I wanted to cover 2 points here. First is basically you're talking to multiple investors and then you got your first term sheet. What should you do as a founder? Like, let's say you have 5 discussions open and the first term sheet comes. You have like 7 days to sign it off.
Yeah. Well, my
or
very
7 hours if it's Tiger.
My, I would say, immediate reaction is maybe not the most satisfying one because that shouldn't happen. Like if you plan out your fundraising process in a proper way, every investor takes almost the same time for the same steps. So if you get a term sheet at one point and you're still at the first or the second call with one of the other investors that you definitely wanted to have and keep in the loop, you already did the very first mistake. Because you need to align on timelines and on the investors, like how you approach investors, how you talk to them, at which stage in your fundraising funnel they eventually are. So keep that aside. Sometimes it happens that you get a first term sheet out of a sudden from somewhere and you need to decide on it. I mean, like investors are, my feeling, very much FOMO driven. So whenever it comes to, like, whenever I hear a company has a term sheet, this is for me, that's for one of the key decisive arguments that I take a second look. Either I take a first look if I haven't done in the past. If I hear they have a term sheet, if I hear somebody else is interested, it's maybe quite comparable to dating. I take also a look. And I think that's one of the dynamics that as an entrepreneur you can play quite well. Don't overplay. I think investors are getting sick of that. But try to play the momentum and let people know that there are fruitful discussions with other funds, that there is something maybe that's also catching your interest, and investors can speed up. We work long hours, but we can work longer hours if we realize it's really necessary to come to a decision, because we don't want to miss out, let's say, on a very good investment just because we were too slow.
It's, I think, very funny if you turn the tables, because I was fundraising myself, and very often you have these signals, you get really excited. And just recently, one of our founders was talking to a US fund, and he came out and he's like, yeah, she's really excited. Yeah, she's like, she loved the numbers and everything. She was very positive. And I know in the meantime, the same person is jumping on a plane to Europe on the company she just kind of learned a day ago. And this is kind of the relative excitement. And what I see is this kind of message. I have a couple of investors who want to follow. I just need a lead. I'm technically done. And like my perspective is, when I hear this, it means you're trying to build FOMO, but really not correctly. What do you think about such signals?
Well, I don't listen to them too much, actually. What I care about and what entrepreneurs should care about is finding a lead for your round. Because as a follower, it's always super easy to sit at the sidelines and then, like, if Sequoia leans in as a lead, or if like Index, Excel, one of the top global funds, try to decide to lead you around, and you have positioned yourself as a follower, it's always easier to say, well, keep me in the loop and maybe I'll decide later once I know all the details, than providing the entrepreneur with a hard no. So as VCs, I sometimes feel we're the master of opportunism. So we would never say a clear no. We always call it a maybe not now. We call it a yes, please keep me in the loop and I'll decide later, because you're such an exciting founder, such an exciting company.
We're bullshitting not to miss the opportunity.
To a certain extent we are, yes. I would agree. So if somebody tells me there's some followers, yes, it's nice. Maybe once you're about to close a round, because the lead will not take the overall round, and in the end all of them can provide some value in terms of value add next to the money. But I also tell our founders the fundraising is not over until they have a lead.
Yeah, I think it's also like, once you have a lead, it sometimes means they understood something you didn't see in attraction. We had a case of a company that had zero revenue, and they had a lot of funds interested, but everybody told, okay, we need just first client to really be signed. And then one fund just gave a term sheet without it, because they had a client in a portfolio who told them, like, it's bought, like, we're totally buying it for a big dollars. So they kind of knew the traction is there before everybody else. And it basically triggered everybody else to be a little bit more interested.
Which is a weird thing, by the way. Like, why should an investor be interested more or less in a company just because somebody else finds it attractive?
Oh, because that probably means somebody found out that there's more than we all saw. Nico, one final point. Because you're investing across Europe, and you spend quite a lot of time, like, we share notes on many companies from the region. What would you say are the core differences between Central Eastern European entrepreneurs and German or Western European ones?
I'm thinking about that question quite frequently, I have to admit. I think, to me, everything comes down in the end to one point, is that within Germany, within more developed ecosystems in terms of venture, in terms of startup scale-ups, more people have seen scale. And I think that's something what really differentiating the German market, the French market from the growing and very well developing Central European market, is that there's more people that actually know how to run a business at scale, and how to do it as an entrepreneur. You have that second wave now, that wave of people doing their second business, a repeat business, maybe the third business, which was, I think the US was maybe 20 years ago at that point. We're now in Europe and in the Western parts catching up on that, but we're still waiting for those kind of like exited entrepreneurs, venture back, that are then building the next business, and are basically by that also educating parts of their workforce on how to build substantial businesses. And I think if that's about the experience part, and on the other hand, and I think that's something that Ariel touched upon, is like what is the ambition level? Like, if I talk to Polish entrepreneurs and they say, well, the Polish market isn't that size, I immediately need to hypothesize that the founders are not thinking about moving, let's say, outside of Poland. Like, why should you, if you have a good solution that's doing 2 million of revenues in Poland, why should you not think about like moving to Germany? Why should you not think about moving to the US? And like having that think big mindset, and I'm very happy to share the stage tomorrow also with Maya on the Inspire stage for a speech about exactly that topic is. But guys, think big. And I think that's something what many of the business schools in Germany are teaching their students from the get-go, like oversell, overpromise, try to put yourself out there, and the rest will follow. Versus, and I think that's something what I like a lot, but I think what people can learn from is that super humbleness that I typically see in the European or in the Eastern European ecosystem, where you sometimes can, I think, also look at your German peers and go their way.
Interesting perspective. I hear that a lot, that entrepreneurs from here are too humble, too conservative, and so on. One final point. You're here for the next 2 days. What are the things that will catch your attention in the companies that you look for?
Very good point. Well, it's a very personal answer that I give. I typically try to come prepared to conferences. So like if people approach me like on the Wednesday, if the conference is starting on a Wednesday, like my schedule is already packed, my matchmaking tool is exploding. So it's really hard to cut through the noise. So what I like a lot, and I think many of the entrepreneurs did, is approaching the investors, selecting the right ones and approaching them before the conference, maybe even have a first call to get to know each other via Zoom and try to do the follow-up on the conference. Because if I meet entrepreneurs on a conference and I have 2 days fully packed of meetings, I maybe have 20, 30 of them, like how can I remember all of those? And you want to be remembered. And if you already missed out on approaching the investors maybe before the conference, at least make it as relevant as possible. So whenever you approach them, maybe don't do it on a matchmaking tool because they receive tons of requests anyway, as I do, but maybe try to find a way to sneak into their inboxes and make a very good like 2-liner pitch why the investor should meet you even though the schedule is already packed. And then I'm super happy to meet all of the amazing entrepreneurs. That's why I'm here, and super happy to share the stage with you, Micha.
Nico, thanks a lot for coming, and good luck with finding your next CEE bets.